Matt, you remain optimistic of a soft landing, but after the RBA's recent rate hike, your internal economics team amended its central scenario and is now forecasting 2 more rate hikes this year, significantly lowering the chance of a soft landing. Why are you confident of a soft landing when it seems your own economics team is perhaps not?
Well, I think they're still confident it's possible. We'd certainly acknowledge it's higher risk because there is still uncertainty about where the cash rate will go. Of course, we agree with their forecast of 3.85%, but we also acknowledge that there's risk to that. As the Governor confirmed today, inflation is well above where anyone would like to see it, the core inflation and the broad-based nature of it. And so rates are going to keep increasing. Certainly, we would think over the next couple of months, and then we'll have the advantage of seeing some of the latest inflation and wages data. Inflation for the March quarter will be out in late April.
Okay, so will Australia avoid a recession?
We believe so. We think the economy will slow over the course of 2023, but will remain positive, more than 1% GDP growth. But it's clearly going to be a more challenging economic scenario this year. And of course, our primary focus is supporting our customers through that period.
So what could push Australia then into a recession?
Well, I think what we would be most focused on is seeing how quickly the inflation comes down. I think the RBA itself has concluded the majority of that inflation has been supply side. And so think Russia-Ukraine war, think about the supply chain dislocation, even weather in Australia. And so how quickly the inflation comes down will be a really important measure where I think the RBA would have more confidence that they could either leave rates on hold and see how inflation continues to change over the course of the year. The other thing that we'll be looking very carefully at is the employment market. We're very fortunate that unemployment is at 50-year lows at 3.5%. We think unemployment could rise to just over 4%, which is still very low by the end of the calendar year. The RBA doesn't think it will change as much as that. So there's a lot of different indicators and data that will be important during that. But ultimately, the further the cash rate needs to increase, the more pressure that's going to put on households. Unfortunately, that's really unevenly felt. There's about a third of households who have a home loan, and they're going to bear the brunt of those higher rates.
So when do you think then rates need to come down to avoid a hard landing?
Well, again, there's so many variables within that. I think our base case is that rates would potentially be coming down at the end of this calendar year. There's a lot of uncertainty around that, but a cash rate of, let's say, 2 more rate increases from where we are, I think hopefully on hold for some period of time, a range of different things to then flow through. Importantly, I think monetary policy and fiscal policy in unison, which the Treasurer has made clear that's a priority for the government. And then perhaps either late this year or early into 2024, depending on how consumption and households and how that's flowing through into broader parts of the economy, potentially rates coming down to ease some of those pressures that are coming from higher rates at the same time that hopefully price pressure from inflation is coming down too. Looking
at your mortgage book now, Matt, what level of interest rates would you expect to start seeing rising mortgage arrears and defaults?
Well, even in the last 6 months, and clearly rates have been increasing since May. Now, admittedly, only about 50% of the rate hikes that have been announced have been felt by homeowners. We would have actually anticipated that there would have been more impact on our customers even over the last, say, 3 months. We're at record low levels of housing arrears, and that's really a ratio that measures what proportion of borrowers are behind on their repayment. So we can see the economy's been remarkably resilient. We do think over the course of the year that's going to put more households under pressure. We see that as a source of concern and worry. We hear from customers directly and we're working very closely. I mean, fortunately, a number of customers are in, or the majority of customers are in a very strong financial position, but it's our job, just like it was during COVID, to support as many of those customers who really need financial support and assistance through that period.
So, Matt, we saw the bank increase its loan impairment expenses in this result, but how much is it putting aside for impairments to cover any impending rise in mortgage arrears or defaults?
Yes, as you said, we increased what's known as a collective provision, so we've topped up to reflect that future uncertainty. One way to think about that is our total provisioning level, about $5.5 billion that we've set aside to be able to cover any future losses. We think that central scenario would be about $3.5 billion. So we've got about a $2 billion surplus. And of course, at this point in the cycle, having strong banks, and certainly the Commonwealth Bank is in a very strong position from a funding, capital and provisioning perspective, puts us in the best overall situation to be able to support our customers and the broader economy.
You've said, Matt, that you're ready to support customers through impending downturns. We know many are coming off fixed rates in a couple of months. If times get really tough, how will you help customers? Will you be looking at mortgage freezes, delays in repayments? What tangible things will you be offering your customers?
A range of different support options. You touched on a couple of them there. Of course, these are some of the measures that we put in place during COVID. They were much more broad-based during COVID, particularly early on in COVID. Once we got sort of greater certainty on the economic outlook, and of course there was a lot of stimulus to support that. It was much more of a case-by-case working with individual customers. But of course, it's our job to be able to support as many customers as we possibly can. There are a range of different ways that we can do that. And we're already proactively reaching out to customers that do have loans that are coming to the end of their fixed rate. Because they've also been on such a low rate, they're actually across the overall portfolio in a very strong financial position. So again, the vast majority of people are going to be able to manage through that without too much difficulty. But of course, depending on individual circumstances, it can be very challenging, and we're here to help them.
Matt, we know that the bank today announced a $5.2 billion profit, but the share price sold off on that announcement around 5% over analyst concerns on the profit margins. Have CBA margins peaked?
Well, we spoke about today that notwithstanding the rapid increase in the cash rate, which improves net interest margins for all financial institutions, we saw a peak in the month of October. As we look forward, clearly that weighed on investors' minds and some of the economic uncertainty. But again, we would stress that alongside that, we've been fortunate to be able to open more than 2 million new accounts over the last couple of years. We're in a very strong financial position. We certainly have the capacity to both promote financial stability at an individual customer level, but also support economic growth. So yes, it weighed on the share price over the course of the day, but for us, it's very much about positioning the organisation for the long term. And I guess one ancillary benefit of a strong result in that 6 months is we'll be distributing a $2.10 dividend to more than 800,000 Australian households who own our shares directly, and millions more who own us through superannuation.
Okay, so just briefly, margins haven't peaked then?
Well, they did peak in the period in the month of October. And of course, what happens from here will depend on a range of different factors, including what's happening particularly in the competitive context in terms of what offers are available in the market. It's a very competitive market, but that's great news for customers. And we're here to both support customers and also make sure that we have very competitive offers for customers who've got their savings with us, customers who have term deposit, their home loan and their business loan. And our business banking division was one area that grew very strongly over the last 6 months, but also the last 3 years.
As we know, Matt, deposit pricing has come under scrutiny. There's an ACCC inquiry into this. Has the bank been too slow to pass on rate rises to depositors? And what do you expect the ACCC to find on the bank's behaviour in this area?
Well, we've worked with the competition regulator in a variety of reviews, and I think many businesses and frankly the cost of just about everything in the course of this calendar year, I think will be under review because of the strain that many households will be feeling. Look, we've certainly tried to strike the right balance. We have a number, as I touched on earlier, of very competitive deposit offers in market, a 4% 12-month TD, our products like Award Saver, Goal Saver. I think they'll do a thorough review. I wouldn't like to prejudge their findings. We're certainly familiar and used to working with the competition regulator. We're an industry that is subject to a lot of scrutiny. We're Australia's largest financial institution. We're here to serve our customers. The occurrence of that review is something that we'll just work through.
And you're happy then with the rate at which these rate hikes have been passed on to benefit your customers?
Yes, I mean, what we'd say overall, because sometimes it's misreported that there's some significant difference between the rate at which changes in interest rates on either loans or deposits are passed on, whether rates are falling or rates are increasing. They operate within about a range of between 10 and 15 days. There isn't a lot of difference across that. Then, of course, it's a function of the quantum that's been passed on to each of those individual products. And we're very confident we've got a very competitive set of offers in market. The pressure on net interest margins, as is demonstrated today, is reflective of a competitive industry. And we know that there's some of the issues that the ACCC will look at.
Matt Comyn, always great to speak with you. Thank you.
Pleasure.